Hello and welcome to this quarterly video of TSP Funds. After a strong month of July supported by good corporate earnings, the markets inverted their trend and started to decline from mid-August. This decline in both equity and bond markets was due to concern about growth slowdown, steady high levels of inflation and aggressive rate hikes by central banks. Interest rates rose to their highest levels over a decade. In that context, US dollar kept its safe haven role. While developed markets lost 6.1% over the quarter, Asian markets were the worst performer with 13.7%. In particular, China significantly suffered, losing 22.4% as concern on the housing sectors and the tightening of the COVID controls drove the investor negative sentiment. The relative good news came from Thai markets, where the SET index was resilient on the back of a sustained economic momentum. On the bond side, persistent inflation and the stronger than expected action of central banks on rates led sovereign bonds to experience their third negative quarter in a row. Global bond index lost 3.3% over the quarter, while global credit index was down 4.3%. As previous quarter, the US dollar benefited from this risk-off environment, gaining 7% versus other major currencies as well as the Thai baht.
Against this overall backdrop, TSP funds retreated and diversification did not protect portfolios. In relative terms, performance of more defensive TSP funds were in line with their benchmark, while equity-oriented portfolios slightly underperformed. We decided to increase the level of cash in portfolios during the quarter. This allocation to cash was a key contributor. In addition, the underweight positioning on global fixed income and Asia ex-Japan in the equity pocket contributed to the performance. Looking at fund selection, the top contributor was Schroeder ISF Asian Equity Yield, followed by the flexible bond fund PIMCO Income. On the opposite, fund selection in the US and Thai equities were the key detractors, while the underweight positioning on Thai bonds was also detrimental.
Looking into the next few weeks, we see the three market themes that will keep volatility and uncertainty high. The first one, politics and geopolitics at center stage. Russia's recent escalation of its wars with Ukraine is a reminder that we are in a new regime of rising geopolitical tensions. Politics is also under the spotlight with US midterm election, the new government in Italy, and elections in Brazil. Then, the central bank's willingness to face inflation by raising rates, increasing the risk of recession. We expect US Fed funds rates to reach 4.75 to 5% in 12 months. The ECB recently hiked rates by 75 basis points, and we now forecast the ECB reference rate at 2.25%, also in the next 12 months. And finally, the slowing growth and persistent inflation. We expect to see an extended period of subpar US growth, while the Eurozone outlook appears gloomier, compounded by the ongoing energy crisis. Inflation in the region is expected to pick up during the autumn or winter season. This toxic mix of low growth, high inflation, and central banks' resolve to restore their credibility translate into a more cautious stance on risky assets. First, we have an underweight positioning on equities, especially in Europe given the downside risk from gas rationing. Overall, we remain very careful regarding corporate earnings, so we keep our bias towards quality stocks. We also favor funds tilted to undervalued stocks or dividend payers. In fixed income, level of yields are now much more attractive, especially in the US, and government bonds should provide a source of protection in case of further deterioration of growth. As a result, we are close to neutral in global fixed income duration. And finally, on credit markets, the picture remains globally positive in the high-quality segments such as US investment-grade bonds, while in the high-yield space, we keep an extremely low exposure.
During the quarter, we modified our investment strategy to adapt the portfolios to the deterioration of the environment. In particular, we decided to reduce our allocation to risky assets. While we already had a defensive positioning on equity over the summer, we cut further equity exposure early September, given the downside risk to growth and central banks' shift towards a more restrictive monetary policy. Instead, we decided to increase allocation to cash in order to protect portfolios. Aside from this risk reduction, over the quarter, we have been increasing our exposure to value funds. First, we switched from a US value ETF to an actively managed fund, Neuberger Berman US Large Cap Value. The fund is managed with a bottom-up approach, and portfolio managers put a great emphasis on long-term earnings and valuations. We also added some position on M&G Global Dividend to get a larger exposure to dividend theme, which usually behave well in time of rising rates. In Asia, we adjusted our Chinese equity pocket by introducing JP Morgan China A shares. Mainland equities are more exposed to local market and have less exposure to tech-related names than Chinese company quoted in Hong Kong. Over the quarter, our China exposure has been reduced on the back of near-term downside risk. On the fixed income side, we increased global government bonds exposure by reinforcing Wellington Global Bonds, and we also invested on a pure US Treasury bond fund, Pictet USD Government Bond. On the other hand, we reduced our allocation to local fixed income by trimming Kongtai short-term fixed income plus. On credit, where we favor high quality, we sold Jupiter Dynamic Bond to reduce our exposure to high-yield bonds, which are the most at risk amid a deteriorating environment. In September, we introduced Fidelity US Dollar Bond, an aggregate bond fund invested in US Treasuries and investment-grade bonds. The fund complements well PIMCO income in our US credit allocation. To conclude, we acknowledge volatility is likely to remain elevated in the short term amid the current backdrop. Nevertheless, please always keep in mind the mid to long-term horizon of an investment on financial markets. TSP funds allow you to diversify your savings and gain access to the best experts. These are the key drivers for long-term performance. We thank you for your support and attention, and we will meet you again in January for the next quarterly video of TSP Portfolios.